The taper continues. $25 billion. The monthly bond buys reduced as we expected. There is new language on the economy reflecting improvement in the economy, the tick up in inflation, but they still see slack in the labor market, and they still maintain that a highly accommodative stance of monetary policy remains appropriate. Let me read through some of the key language with regard to the economy. Growth in economic activity rebounded in the second quarter. Labor market conditions improved, with the unemployment rate declining further. However, a range of labor market indicators suggest that there remains significant underutilization of labor resources. Household spending appears to be rising moderately, and business fixed investment is advancing, while the recovery in the housing sector remains low. Some new language here on inflation. Inflation has moved somewhat closer to the committee's longer-run objective. Longer-term inflation expectations have remained stable, but they go on to say the committee sees the risk to the outlook for economic activity in the labor market as nearly balanced, and judges that the likelihood of inflation running persistently below 2% has diminished somewhat. So they have acknowledged, again, the tick up in inflation, but they still see slack in the labor market. Again, with regard to the taper, they're committed once again, to continue to reduce the bond buying at measured steps over the course of the next few meetings, but they don't commit explicitly to October in this statement. And again, they're going to continue to reinvest the proceeds of the bond buying. There's no stop to that. In terms of forward guidance, no real change in forward guidance. They maintain once again that it likely will be appropriate to maintain the current target rate for the federal funds rate for a considerable time after the asset purchase program ends. And that is the basis for the one dissent here. Charles Spasser, the Philly Fed president, he objected to the guidance, indicating again that it will likely be appropriate to maintain the current target range for the federal funds rate for that considerable time, because such language is time dependent and does not reflect the considerable economic progress that has been made toward the committee's goals. Charles Spasser, the lone dissent here. So perhaps something in here for everyone. Certainly some notice for inflation, but the Fed still seeing slack right now in the labor market despite some of the recent improvement.